Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Happy New Year to you as we launch 2023 and enter this new year. I want to share some recapping thoughts for 2022 and a couple of things that we're looking at as we move into this year. And we'll certainly keep you apprised as we move throughout this year and make all the necessary adjustments along the way. So for today, we're going to take a look back at 2022 and where we fell in history. We'll take a look at real rates. Can't promise that to be the most exciting topic, but we'll address it because it is in many ways kind of at the center of the investment universe. We're going to take a look at the Fed's playbook. As always, an instrumental player, the driver behind market. So what are we looking at in terms of Fed action? And then lastly, Andrew will chime in and give us an update on gold. So let's start off with 60-40 portfolio and taking a look at history. So this is something that we've hit several times last year as we were making different levels and breaching levels of the past. So here's a look at the prior list of the worst years for 60-40. So 60% S&P 500, 40% Treasury bonds. If you look back through history, actually 1974 now will no longer be number three. 2022 came in just shy of 17% to the downside. So truly, it was a painful year. 2008 is the year that sticks in a lot of people's minds. But in that year, Treasury bonds helped, at least a healthy 40% allocation to Treasury bonds helped offset a lot of the pain that was in the market at that time. So 2022 wound up worse for diversified portfolios. You guys know that by now, but just to put a final pin in it, we actually are just shy of those two horrific years of the Great Depression in terms of a balanced portfolio. Flipping now to real rates, this was one of the reasons why it was difficult for both stocks and bonds. So real rates, what we're talking about here is the return you earn on Treasury bonds after you account for inflation. So you can actually buy a variety of Treasury bonds that lock this in a real rate format. So you don't have to worry about inflation. Your return is going to be whatever that stated real rate is. And if I just kind of point you on why this was an important last year, just take a look back over time. If you were to look at, say, 2009 and 10, real rates dropped dramatically. This was the Fed policy to create a negative return environment, and that drove a lot of money out into risk assets. So those were really good years in the market. It's not that 2014 to 2018 were bad by any stretch of the imagination, but markets kind of digested a lot of the gains. And they were more concentrated in certain areas. And then, of course, we had another good run, 2019, save for the COVID crash. Putting that aside, there was a good run there as rates redropped to minus 1%. But I just point you to how rapidly it rose as we went through 2022. We went from a negative 1.2%. That's meaning that's the option that a conservative investor had to lock in a negative 1.2% rate for 10 years. That all of a sudden shifted to 1.5%. That creates a lot of competition for equities or any other investment. That is a big dramatic change, and that's what the market had to adjust a lot for. The good thing that I would point you to is now that we have a positive return baked in here. It doesn't mean that we wouldn't see or couldn't see another negative year, but that rate of change would be very difficult to repeat in 2 consecutive years. Turning next, the third point that we will cover this year is the Fed's playbook. So following that, of course, real rates, one of the reasons they went so high was because the Fed raised rates so dramatically. So what are we looking at for 2023? We have essentially 2 different things plotted here. There's one, what the Fed has told us is going to happen. That is the blue line. We expect, based on what they have told us, to see a hike a few more times until we level off just over 5%. However, the market tells us that we'll peak out a little bit lower, under 5%, and then begin to decline. The market expects by the end of this year that they will actually be working to cut rates. So do have a pretty strong divergence there. Which one will win out? Time will tell. Would certainly be a strong indicator which way a good chunk of the market will go, whether the Fed sticks to their guns or whether the market's right and we wind up cutting in with some rate cuts. So time will tell on to those two. Point number 4 here, we're going to talk about gold. I'll pass the baton to Andrew. Finally let him chime in here on this point, which is so very important. So Andrew, what are we looking at in gold?
Thank you, Adam. So here is a long-term chart of gold going back to 2015. One of the pieces of data that's fairly unique, and we just don't see a lot of investors or money managers using, is a weekly report that we get that actually tells us how our traders positioned within a specific market. We can actually look and see how many people are long oil, gold, treasury bonds, different currencies. This is published every single week. It's probably one of the most underutilized pieces of data. And it's something I spend probably 2 hours going through every single weekend because it's extremely valuable. But today we're going to look at just gold. So we can see that for the gold market over the last several years, traditionally money managers, large institutions, typically are long gold. They own more long positions than short positions. And you can see that by the red line on the bottom panel here when it's above that zero line. This is the number of contracts that they're holding. And so historically, when they do go net short, meaning they go below zero, they're shorting the gold market. That doesn't happen very often, but when they reverse those positions, it's been very positive for gold. And so this was something we started seeing earlier in the year, that money managers, these large traders, went net short gold. And so we said, okay, now let's start to watch and wait and start looking for opportunities to when they start to reverse and start increasing their interest in gold and the shiny metal here. And that's what's been happening over the last couple of weeks. We're starting to see gold start to rise and really start to strengthen here recently. And money managers have begun once again going net long, increasing their interest in owning the futures for the gold market. So this is a positive development for gold. We're seeing it continue to hold support above $1,700 an ounce. And so we think this is a positive for gold. We don't have to look at the implications for inflation, geopolitics. We just want to know, are there more buyers or more sellers within a market? And right now, it really starts to look like we're seeing an increase in buying activity in gold futures. We'll see if this continues into the new year. But right now, it's been a positive catalyst for gold prices.
Very good. As always, thank you. Thank you all for watching and giving us a few minutes of your time here as we start out 2023. Don't forget, especially as we turn and we start a new year, please give us a call. Come in and see us. 800-928-4001 to give us a call, or scan the QR code and book it electronically. So thanks again for giving us your time, and have a great weekend.